Hello everyone. Welcome to our discussion here using the PowerPoint slides of Chapter 6, our last chapter, kind of building the whole term to this chapter. This is the kind of thing that businesses and business owners always want to know to understand financial information is how these accounting events, things that we talked about in chapter 5, affect our financial statements, which we learned how to put together in chapter 3. And to do that, we're going to use some ratios. That's what's new in chapter 6, is how we take that and use some mathematical formulas to help us understand what's happening. Now, we don't want to let any of the math intimidate us. It's just dividing. Typically, it's nothing complicated. It's just a matter of following the formula and be able to plug in the numbers and think about the relationship between the numbers on the financial statement. So, to introduce why this is important, we want to talk about cash collection cycle. One of the things that's really key about a business is it has to have cash. That is an essential asset. So it's an asset, you control it, we own it, but it's not very effective because it doesn't create return. Cash is sitting in your bank account is going to earn a little interest, but it is not going to help a business grow. It's not going to make it more of a product, any of those things. So we need cash to pay our bills, but we don't want to have too much. So what we want is just a constant flow of it coming in. Okay? And so this is important enough that we have a term for it that is sort of unique to business and accounting. Liquidity. And that is the measure of having cash resources available to pay our bills, to go after new opportunities that you need cash to pay for, or some other, liquid asset. And so those resources and how easily we can obtain those, either by having them on hand or being able to convert other assets into cash, is how we determine liquidity. And this is important enough that we list our balance sheet assets in order of liquidity. So on the balance sheet, we've noticed, and we've looked at companies' balance sheets all through the term, that the first asset is almost always cash or cash and cash equivalents, something of that nature, indicating that is listed first for some reason. And the reason is that is our most liquid asset. That's one that is obviously most easily turned into cash because it is cash. And everyone after that is listed in how easily it is to turn into cash. Okay? So that's based on liquidity, or how easy it is to make it become cash. Now, cash has its other downsides. There's a risk of loss. If someone is going to steal from your business, the most likely asset that they will want to steal is cash because of its ease of spending. Okay? It is also prone to error just because there's a lot of transactions, and they tend to be with lots of different people, all of which means that there's a lot of room for error. And so what that all means is, because cash is important, it's a key asset, we don't want to lose it. But people are out to get it, perhaps dishonest folks, and there's errors easily sometimes happen. We need the best internal control procedures, like we talked about in chapter 4, internal controls and ways to oversee the handling of cash. So if that's an important asset and we don't want to just have a stack of it somewhere, then we need a constant flow. How do we collect more cash? How do we get more of this key asset? Well, basically three ways. Okay, three ways that we want to talk about in terms of the cash collection cycle. This is how a company must be. They can temporarily borrow money and get cash. They can temporarily also get money from stockholders. In each case, that is not an infinite amount. That is a finite amount. That's going to run out. At some point, if you keep borrowing, the bank is going to say no. The stockholders are going to say no when you go to them for more cash. So we need to have ways to make cash sales. That means we literally sell it to a customer and they pay us cash. Very straightforward. We can see that increasing our cash right away. So we convert inventory, you might say, directly into cash. Credit card sales, okay, is something you're very familiar with because probably most of us are paying for most of our things with credit cards, or an awful lot. Okay, so on the side of those that are accepting that credit card payment, how does that look? Okay, well, for a business who accepts your credit card, at least a Visa, MasterCard, and American Express, those major cards, that is like them accepting cash. So what's happening is you are borrowing from the bank that issued your card the money to pay for the item at the store as you check out. That's what, when they swipe your card, that's essentially what's happening, is the card company and the bank together are approving, if it comes back approved, a loan. All right? To you that you never see. It just goes directly to the company, the store that you're at. Okay? So who do you owe the money to on that? The credit card company or the bank, right? If it's Discover, it's the credit card company. If it's Visa, that's almost always a bank involved in between, in with that. So that's who has to wait for their money, is the bank that's involved. That's what they're in the business of doing, is loaning money, right? So they're making you a short-term loan and charge, of course, you interest if you don't pay it off on the cycle that you're supposed to. All right, that's how credit card sales work. But for that service, for that willingness to make a loan on an instant basis, right? Literally, it takes seconds. They're going to charge a fee for that, right? And so the company, Target or Walmart or wherever you're shopping, doesn't get the full amount of what you pay, or of the loan you just took out and paid to them. They get a portion of it. Usually there's a 2 to 3% fee on that, which they are most likely very happy to pay because it makes their life fairly simple. They do not have to worry about collecting that money later. They've got their money right then, albeit only 98% of it. And they've left that whole problem of trying to collect from you later to a bank. The last one on our list is what is in accounting called or referred to as a credit sale. Notice, credit card sale is not a credit sale. It is a cash sale to the business, minus the fee. Credit sales are we're selling to a customer now, and they agree to pay us later. The amount that we are expecting to receive later is referred to as accounts receivable or trade receivables. And we've seen those as we've looked at real financials. Now we're going to dive into how those affect the accounting equation. When that happens, we have to agree to some kind of credit terms. That means, when are you going to pay it, customer? And am I going to give you any incentive to pay it early or at a certain time? Of course, this adds a layer of complexity because I'm less likely to just sell it to anyone if I expect them to pay me later. They've already got whatever I've sold them. So it's harder if they determine not to pay you to collect. So we're going to check some of that background of our customers, right? We're going to identify their credit score, perhaps, or other ways. Typically, these credit sales are made from one business to another, and especially those who do a lot of business together. So you don't, because it is expensive and time consuming to check credit on lots and lots of customers. So businesses, while they may have 100 customers that sell to other businesses, that compares to how many millions of people walk into Walmart every day around the world. It would be infeasible for them to have any possible way of checking the credit score of those people and deciding whether or not they should allow them to pay for their purchases at Walmart later. So when we create a credit sale, when we have sold to customers, in order to make it more, advantageous for them to buy from us, there's going to be the possibility that they are not going to pay all of the amount they owe. Or that out of the list of the hundreds of customers we've sold to and expect to collect from, one or two of them, maybe 3 or 4 of them, who knows, are not going to be able to pay. Despite the fact that we checked their credit or looked at their financial statements or whatever, some things just happen. Okay, their warehouse floods and they don't have insurance. And it may not matter how well off they were financially prior to that. They may really struggle to pay any amount they owe. So those kinds of things can happen. They're not all going to be collected. We create a separate column on our worksheet, separate from accounts receivable. We don't want to use the same column as accounts receivable. We're going to use a separate column and call it allowance, or allowance for bad debts, or allowance for doubtful accounts. You'll see a lot of different terms, all of which should include the term allowance somewhere. And this isn't simply an estimate of how much is not going to be collected. And it is just that, an estimate. Remember, we talked back in chapter 2 that there are things we cannot get exactly right on the financial statements. This is perhaps the easiest or the first actual example of something that we truly are estimating at this stage of learning accounting. I mean, we're only 6 weeks in. All right, so this is an important one, kind of sets the stage that this may happen more often as we go forward and learn more. Now, that doesn't mean that companies aren't going to try to reduce that. They just throw their hands in the air and say, oh, well, I guess they're not going to pay us. They try to minimize it by checking. And they do offer incentives or other things to try to get money paid to them, perhaps if a company is struggling, we want to be at the top of the list of the people they're paying, not the bottom. And so we may do things that will help move us to the top of the list, speed up collections. When we estimate the amount that we're not going to pay, we're going to look at our history of how many customers do we have this kind of problem with on average. And what has changed in the economics? Are we looking at a recession, and is that going to make the number of our customers who can't pay their amount that they owe to us go up? Or is it not affecting the people that we sell to, the businesses we sell to? Okay, so we can just pull an estimate out of the hat, but GAAP is telling us we need to do our homework in trying to come up with an estimate. We're not just pulling out a random number. We're looking at a lot of factors to try to consider what that is. Now, the last thing that we talk about with regard to allowance is when we reach the point that we have tried to collect from our customers. So we have a customer that maybe had some financial difficulties. We didn't know about them when we sold them product, but they are having difficulties. At some point, we're going to say, going back and forth, we may try different collection methods. We may just throw in the towel and say, we're spending too much time and effort trying to collect this money compared to what we're going to get, because no matter how much we hound them, they don't have the money to pay. Or they have disappeared. Or whatever the circumstance is. At that point, when we give up collecting, that's referred to as a write-off. I mean, if you think about, if you had your list of customers you were trying to collect from, okay, and you put a check mark by the ones as they collect. Back in the old days when we did all pencil and pen and whatever, and if someone couldn't pay you and you just decided, all right, I'm not going to give it, the old, you just, they're a widow. In the old days, it was the widow that came into the general store and couldn't pay her bill. You say, don't worry about it. Okay? Cross her off the list. That's why the term write off. You just kind of write through it and take them off the list. Well, of course, none of that's done that way now, but electronically, we're going to literally put into our accounting system that we don't expect to collect that money anymore. Right? So, moving to the balance sheet and how this looks on the financial statements. All right. You have accounts receivable, which is the total amount owed by customers, which you're not going to see on the balance sheet. You subtract from that the allowance, the estimate amount that you're not going to collect. And then that total minus the allowance is your net accounts receivable. So that's what you actually believe you're going to collect, right? Total owed minus the allowance equals your net accounts receivable. And that's reported, and you'll see the term net almost always on the balance sheet in describing accounts receivable. For that very reason. That is the number, okay, that GAAP says we have to tell our readers of financial statements. Now, let's jump over to look at how this whole idea might play out in the accounting worksheet. So here we are with you might say a simplified accounting equation worksheet. We have assets equal liabilities plus owner's equity, as we've learned all along. Under assets, and we made liabilities really small because when we're talking about the cash collection cycle, we don't dealing with liabilities. So we know nothing's going to really impact any columns under liabilities. So we're going to make it small so we can make the part that we're going to look at, assets and equity, bigger, right? Make it easier to read. So for this example, we're going to have 3 columns: cash, accounts receivable, the allowance, either allowance for uncollectible or whatever you want to call it. But notice it's a separate column from accounts receivable. And then over here under equity, okay, we're going to look at the retained earnings part. We're going to not use common stock or anything like that. So retained earnings, revenue, expense. So in our example here, if this were, and this is how the problem in your homework is going to read, okay, you're going to have a beginning, the amount owed by your customers from last year or last accounting period. In this case, that was given to us at 1,000. And the amount that it should be in the allowance is 50. Notice it is minus because it is always subtracted from the amount we receive. This is the amount we're not going to receive. So if you want to think of it in that terms, okay, it's always a negative. And that's different. That negative shows that it's kind of different than other asset accounts, which are always positive. Okay. So those two, how we start, that's what we know from last year. Now we'd also have cash balance, we'd have other accounts, but we don't need to worry about those to illustrate what we want to see in this cash collection cycle. So the first step in the cash collection cycle is we make sales, at least involving credit sales, which is what our focus is right now, is we make credit sales on credit. We increase accounts receivable because we didn't get any cash. We did what we were promised we would do, so we earned the revenue. So both of those increase and we stay in balance. Then we collect cash from our customers over the course of the year, or however you want to think of this. And the cash increases and our accounts receivable goes back down. So if you think about it, they started with accounts receivable at 1,000, went up by 5,000, and down by 5,200. We're at 800 accounts receivable. Okay. Now, we also had a write-off, and this is how write-offs work. The accounts receivable is reduced because we don't think we're going to ever see this. We scratched their name off our list of accounts receivable. Okay, so we have to know how much in dollar amount we expect that we gave up on, and in this case it was 40. And this could be millions, billions, or just regular dollars. Doesn't matter. They all work the same. And when that happens, okay, it's kind of like our estimate came true. And so we take it out of that estimate, meaning we increase, if you will, or make it closer to zero, the allowance. See that decrease there and increase there, offset, keep us in balance. That gives us accounts receivable 760. So we look like, or in our accounts receivable, our customers owe us $760 million, whatever you want to refer to it as. Now, what typically happens is we make it, then at the end of the year, we're not making this estimate, the allowance, every day. It would be very cumbersome. So we may wait till the end of the year, maybe end of the quarter, and we estimate. Remember, we do our homework. We figure out, what the economics are, what things look like. And in this case, we estimate that 3% of this 760 is not collectible. We'll assume a lot of very astute work went into getting that number. And we didn't just pull it out of our hat. 760 times 3%, that means 22.8 or 23, to keep everything nice and rounded, is not going to be collected. $23 million, $23, whatever this is. So that's what our allowance should be. Well, we had a negative 50 and then a positive 40. So we're at negative 10. And we need it to be 23 or negative 23 in the allowance. So how do we go from negative 10 to negative 23? We have a negative 13. When you put that negative 13 in the allowance, of course, you have to balance it on the other side of the equation. When that is a negative, the other side that always balance that is an expense. Bad debt expense. Uncollectible account expense. Whatever you want to call it. But it is an expense and going to reduce our net income and our owner's equity. Notice when we did a write-off, it didn't change our equity. But when we make an estimate and find that our estimate needs to be changed, or our allowance needs to be changed, that's when we record an expense. So the end result of this, as it said in our slides, on the balance sheet, their accounts receivable with 760, which probably would not see. That's the total amount owed. That's from this column. The allowance is 23, right? At the end of the allowance, after we put in the negative 23, we're at negative 13. We're at negative 23. That's how much we estimate we're not going to receive. So the number you would most likely see on the balance sheet is 737. It would say net accounts receivable 737. It might in parentheses say net of the allowance, or after the allowance, of 23, which of course would give you enough information that you could go back and recalculate the 760 by taking the 737 and adding the 23. That would tell you that would necessarily have to be the amount that was owed.